Hello, everyone. Hope all of you are doing fine. Good afternoon, and wishing all of you a great financial year 2025-26. 2024-25 was a very exciting year. The year I can say was broken into two parts. The first half or the first half of 2024-25 financial year, we saw the equity market rallying to new highs. And in the second half of the year, we saw a very meaningful correction in markets, especially in the last quarter of 2024-25, a meaningful correction in mid and small caps. As we start the new financial year, a lot of announcements have come yesterday night from Mr. Trump on tariffs and the way the US is sort of going to tax all sort of imports coming to their geography. This will create a lot of volatility in markets, and I'm sure we've got the best person to answer all of this. And I'm very happy to say that I've got Gaurav Mishra joining me today to cover on not only markets, but also cover on the 17-year journey for Mirae Asset Large Cap Fund. Gaurav has been with Mirae Asset for now more than 6 years. He manages Mirae Asset Large Cap Fund and the Focused Fund since joining Mirae Asset, and has been instrumental in sort of creating a good track record for our funds over this sort of period. So welcome, Gaurav, for today's webinar.
Thank
So Mirae Asset Large Cap Fund will complete 17 years of track record on 4th April, which is tomorrow. And it's been a very exciting period for us at Mirae Asset, as this is our first flagship fund and it completes 17 years of track record. Similarly, we also complete 17 years of track record of managing equity funds during this period. Very happy to share that over this 17-year period, Mirae Asset, from a very small, humble beginning, has now crossed 2 lakh crores of AUM, out of which 1.6 lakh crores of AUM is through equity funds. And the largest fund for us is Mirae Asset Large Cap Fund, which is close to about 40,000 plus crores in size. So Gaurav, Mirae Asset Large Cap Fund will be completing 17 years tomorrow. It's been one of the oldest and our flagship fund. Can you reflect on the journey over the last 17 years and share your overall strategy that you've been able to do for the last 6 years managing this fund?
Yeah, sure, Vaibhav. And first of all, good afternoon. Yes, the large cap fund actually was running as a flexi cap fund actually since inception till, of course, 2019, wherein it converted into a large cap fund as per the SEBI classification. Thus, from that period of 2019, the fund has at all times been deployed in at least 80% in the large cap category. However, during all the avatars, one characteristic which has stood out is the fact that during major market drawdowns, whether it was the GFC in 2008, or after that the Eurozone crisis in 2010-11, in more recent times the COVID drawdown, or even in the last few months, the fund typically has done better in during periods of market and drawdown. Additionally, for investors in the longer term horizon, when we look at any SIP which has been underway for 5-year period, in any of these 17-year journey, there at least in 93% of the times the fund has delivered over 10 to 12% returns on an annualized basis. As managers for us, of course, as the size of the fund has grown, the complexities involved in managing the fund have changed in this period. But we are highly cognizant of the trust investors have had on this fund, and our endeavor will be to do our best to keep to that.
Sure, Gaurav. So you alluded that Mirae Asset Large Cap Fund over the last 17 years started maybe first as a flexi cap fund, and after the SEBI categorization moved to the large cap category. But what has been the investment philosophy and the strategy of the fund, and what is the overall strategy and the approach you do while selecting, stocks and sectors in this fund?
So, I mean, there has been consistent approach towards both stock selection and the portfolio construction. So at the stock selection level, the approach in a nutshell has been to invest in quality growth companies which are available at a reasonable price. And at the portfolio construction, at the portfolio level, it's been an approach where we've kept 70% of the deployment towards long-term structural stories and 20 to 30% in deep value or special situations or cyclicals, which the market might throw up at times. So that's been the approach, a sort of barbell approach, which we have consistently followed all this while.
Sure.
Additionally, if you look at it, our active weights at the stock level have typically been over 2 times the active weights at the sector level. So we've been taking very active calls when we're picking up stocks on a bottom-up basis, whereas at the sector level, it's been a bit more constrained. And of course, post the recategorization, the fund moved into a plus 80% large cap category. But when we look back, even prior to 2019, for a few years prior to that, the fund was already anywhere between 70 to 75% deployed in the large cap category. So in that evolution, in that migration, there's an additional 5 to 7 percentage point only, which had moved into the large cap cohort.
Sure, Gaurav. So, we've seen that in the recent times, there's been a lot of volatility which has happened in the market. And, a lot of sectors have been impacted significantly. So can you mention and elaborate your current positioning of the fund, and what is the sort of rationale for this positioning?
Sure. So, I mean, currently we are in a very interesting juncture where surely the domestic macros to me are looking good and in fact getting better, though the uncertainty from global cues is immense. Having said that, again, within the domestic economy, it's not as if there is some very clear strengths of huge growth visible across the bigger parts of the system. So we would therefore, under these circumstances, persist with that first attribute I mentioned earlier, which is to stick with businesses which are good on quality, which have robust business models. I think that will be the first line of defense. No doubt, during periods of economic vulnerability and otherwise, volatility in the markets, even our good quality names exhibit that same magnitude of downticks on bad days. But I think this approach will ensure that at least the capital is protected. These businesses will come back, and they do so typically stronger when things turn around. So I think that clearly will be the first attribute in a business which you would want to persist with. And of course, as you might imagine, that the markets can get very volatile, and it has to do with a mix of all sorts of investors with all sorts of horizons. And in that context, we have taken a call that we would rather be focused on businesses with the more medium and long-term view. So, as they say, in the short term, the markets can be a bit of a voting machine, where the sentiments of fear, greed, etc., drive shorter movements. But over the longer terms, I strongly believe that the markets will do behave as a weighing machine, meaning that the merits and the economic value add which a business does will get rewarded. So in this context, we'd want to remain largely, at least 70% of the portfolio, with businesses where we think there is a there is a more medium long term structural driver behind them, and we would want to kind of participate in those stories. So that's been the approach, and also given the fund size we have, I think that's it's appropriate that we kind of remain true to that. And of course, to your question on weights sectorally, uh, at this stage, I mean, amongst the bigger sector overweights are you would be overweight in the banking, financials, and insurance. Uh, we would be overweight on even the consumption spanning from discretionary retail into home building, and also cohorts within the specialty chemicals. At this point, major underweights would really be the conglomerates and also the power space. So yeah, that's in a nutshell, how sectorally we are positioned right now.
Sure, Gaurav. So like we started, the fund sort of has completed 17 years of track record for a very long period of time. Mirae said large cap fund or, India opportunities or the equity fund as it was called earlier, went through a very long stage of consistently being, either quartile one for month on month or quarter on quarter for a very, very long period of time. In the last couple of years, we've seen that the fund had been impacted and the alpha generation was impacted during maybe couple of years very recently. Can you elaborate on, what were the reason that you saw an underperformance for maybe the last couple of years? And we've also seen that in the last year or so, there has been a strong rebound in the performance of the fund. So have you made any meaningful changes in the portfolio, which has led to the improvement in performance? And maybe can you elaborate on what is the sense you get from going forward, how you would be looking at managing this portfolio?
So, yes, undoubtedly, there was a period, in some time back when there were challenges. But if you go back to say, the last half, the second half of 2023, from the September October period till say mid of last year, and if you see, the markets, the large cap index at that stage rallied by over 38%, in a span of, let's say, within 3 quarters. That and that rally started from a valuation level which was already fairly, at par, which was already not cheap. It was a fairly valued market, and from there the markets rallied another 38%. And then when you think of what was happening to earnings in this period, it wasn't as if earnings were sort of getting upward revised. If anything, the forward 12-month earnings were getting cut gradually, such that actually we've ended FY25, the forward earnings which the market would have been looking at that stage, with just a sub 10% sort of growth. So that rally we saw was really one led by a huge re-rating. And in a way, our approach of investing in quality growth, but at a reasonable price, kind of held us back from chasing sectors or stocks where valuation comfort was not there. On the contrary, if we had positions in some of names, whether it was defense, whether it was in infra, capital goods, and we felt that valuations were appropriate, we had taken calls to exit. Except that those stocks went to further re-rate to levels which were pretty out of sync. And then subsequently, as those excesses have unwound themselves, the performance and the underlying positions we've had have helped performance to claw back. So yeah, that's how I'd put this phase you're referring to. Also, to us, it was evident that post-COVID, all governments in the world had this sort of freedom to go about supporting their economies, and the same happened in India. and we saw the Indian government, spend lots more on infrastructure post-COVID to revive the economy. So we saw infra spend as a share of GDP go from within 1.5% to 3.5% in a span of 2, 3 years. And on an annualized basis, that spend was growing at 25 to 35% range for a few years. But even a year and a half ago, to me, it appeared that this is not going to sustain. If anything, post-COVID normalization, governments, including in India, would have expected to go down the path of fiscal consolidation. And that's how things have transpired. And even as we speak now, the journey from the government side has been is one to reduce their deficits in this year and also in the next year. And therefore the momentum or the expectation which was built for a certain cohort of the market in the infrastructure, rail, defense, all of that has moderated. And it wasn't as if we were seeing some major private sector capex cycle. There, of course, it's a very nuanced cycle which is underway in select pockets, but not one at a very big aggregate level. So we were cognizant of that, and we just stuck to our belief and our positions appropriately during this phase.
Sure, Gaurav. Thanks for explaining the sort of reason why the underperformance was there for a couple of years. For a fund that's been having such a long track record of about 17 years, I'm sure there can be a blip for a year or two. But if you see this track record for about 17 years, fund has been able to deliver about 4-5% higher return compared to the benchmark over such a long period of time. It just tells you that overall the investment process, the strategy, etc., has not changed, and it's only sort of few minor calls in some sectors which would have sort of impacted the strategy. So just Gaurav, going ahead on what you had mentioned, that fund was sort of underweight or had avoided few sectors where you felt the valuations were sort of stretched or frothy. We have seen that segment of the market, whether it's PSU, defense, infra, etc., see a sort of a meaningful correction in the last sort of 6 months. Have you sort of changed your stance in any of these sectors, uh, or you've sort of stuck to your existing sort of portfolio stance across sectors? And any other major changes that you would have done over the last 6 months, considering the sort of correction that we've seen in the markets?
Yeah, I mean, at this stage, as I was mentioning earlier, we're not seeing some clear signs of huge growth in any particular sector, so to say. We're agile and open to that and looking forward actually to some growth coming back strongly. But till then, we are trying to use this volatility to essentially pick up good businesses, meeting those attributes I was referring to, on a bottom-up basis. And at this stage, therefore, what's happened in the last 3, 6 months is that we are getting ideas which are representative of sectors ranging right from capital goods to even consumption, both staples to discretionary, where we are comfortable with the growth or the otherwise the value proposition that particular business is offering or is addressing. So I'll say that we're trying to use this volatility opportunistically, but it's really not sector specific. It's really bottom up across sectors.
Sure, Gaurav. So maybe let me just go back maybe 3-4 years back. There was a common perception among a lot of market participants that alpha generation in large caps has sort of gone down, or alpha generation is completely lost from the large cap segment. And I think that thankfully over the last 2-3 years, a lot of large cap funds have been able to dispel this belief that large caps cannot generate alpha compared to the benchmark. What is your sense on this debate on alpha generation, especially in the large cap space, and what sort of makes you confident that overall large cap as a category and well managed funds can sort of continue to generate alpha in this space?
Well, as you're pointing on, last couple of years, we have seen large caps as a category do better than benchmark. But really my conviction for this category comes from the belief that where we are as an economy is one where there's still lots of growth to be had in the next 5-10 years at least, if not more. So, if we are a $4 trillion economy, I think we'll surely be getting to the 7-8 trillion mark as well in the years ahead. And India is a fairly diversified economy, and the stock markets have a very broad and diverse representation of different sectors of the economy. No doubt, there are certain sectors which are more represented in the large cap cohorts, and some which are not so. They might be more captured in, say, the small and mid cap. But in any case, there are enough sectors which are captured in the large cap, such that if India were to become in size, what we are referring to, doubling in size, it can't be that those large parts of the economy don't participate. Whether it's the banks, which is, as you might imagine, if the system grows, the banks have to, participate in the whole credit process, or whether it's the consumer names, not just the staples, but other discretionary or healthcare categories, some of the exports. We're seeing a lot of turbulence there, but I think there are enough sectors where India has a global proven competitive advantage both on quality and cost. So I think there are a host of sectors which are going to be very relevant, as long as India keeps growing, and those industries, those sectors are actually captured nicely in the large cap. So as long as stock selection is done appropriately, there's every reason that it's possible to do a good job, even in the large cap category. Of course, having said that, there are periods of time you were referring to earlier, where, for instance, in the large cap, if there is a certain segment within the market, whether a certain sector within the index which it just does very well, where the prices, just go berserk, but where valuations don't make sense, and if managers have kept away from that, it can hurt the relative performance to the benchmark. So we saw that, a couple of years ago when one particular big conglomerate got re-rated to, completely irrational levels, and as that unwound, then things stabilized. So yeah, I mean, there will be these periods when some excesses drive the index, but over longer periods, I think they will average out. And as long as the manager is doing a good job of sticking to his philosophy and doing so diligently, outcomes should be satisfactory.
Sure, Gaurav. Thanks for sharing that perspective. I think so. Over the last maybe 3-6 months, market seems to be in a perfect sort of storm. Market had sort of rallied too fast, too quick, and valuations had become sort of discomforting. Domestic macros in India still look sort of quite good, except maybe the earnings, if we see over the last quarter, like you alluded, was showing a slowdown. But the news flow from the global side has been sort of very, very volatile, and especially after Mr. Trump taking charge as the president for United States, there's been a lot of announcement on tariffs, which has created volatility in markets. So can you share what is the sort of overall perspective you have on markets, and how do you think investors should sort of invest with the current volatility that you are seeing, with at least a sort of 6 to 12 months time frame?
Yeah, I have a very constructive outlook on the markets, but I will caveat that and say that this constructive outlook is really for an investment horizon of over 12, in fact, more like 2 years, such that you kind of get decent good returns, maybe with volatility thrown in. In the short term, of course, as you're pointing out, there's just too much uncertainty from cues coming globally. So if a few months back we are hopeful that once the US elections are over, there'll be some sense and on the policy side and stability, we are seeing that it continuing, the uncertainty. So even overnight, while we have had announcements, much awaited announcements on tariffs, but I think we are just still in that period of policy uncertainty. I think this is going to continue for a while because even as we speak, there'll be reactions from some of the major trading partners, the European Union, China, etc. And so this, uncertainty on the trade front and the impact, second order, and all that will, still be very much there. Having said that, even from the US itself, President Trump himself has more sort of policies which has to pursue besides trade, on his fiscal side, on his deregulation side. Each of them will have some implication, and maybe some bearing for some Indians, sectors. And of course, then there's the US Fed, which otherwise has been pursuing inflation, but was on an easing cycle. I think somewhere if growth really starts looking much weaker, I would think that maybe they'll start refocusing back on growth over inflation. So there's just a lot of uncertainty coming from, that big geography. We know that India is not so exposed in a way, except for a few sectors, but the vulnerability and volatility through, the capital markets is always there. Otherwise, on the other hand, it's not just so gloomy globally as well. I mean, there are parts of the global system which should have been looking better, actually. So Europe, for instance, has been fiscally, relaxing and getting more expansionary. They're looking to spend much more on defense. The ECB there has been cutting rates, and hopefully, if the Russia-Ukraine war were to cease, then there could be a good sort of momentum coming from that geography, which otherwise has been such a laggard. Similarly, China in recent times we have been seeing some good signs of private sector activity. So yeah, I mean, otherwise, on the global basis, when we look back the last couple of years, the year always looks at the start that for some reason, earlier it was the monetary policy, that there would be some slowdown, in fact, a recession. Each of the past few years, I recollect there has been that call, and it's turned out to be the other way. The global economy has held up very well in the last couple of years. This time around, can't say, maybe it's different, but it'll be really fairly because of policy mishaps and missteps, and we are in the sort of middle of that. So no doubt there is this uncertainty which we have to deal with. And as I was saying earlier, I think we have to just stick to good, strong business models, which are addressing, structural opportunities to kind of ride this phase. On the other hand, of course, as far as the domestic piece is concerned, the domestic story, there's, I think, just better and good news in incrementally, so to say, in the last few months. So if we hit a low on GDP growth in the second quarter, since then, sequentially, it's just been picking up, whether it was the third quarter, which has gone by, and I think we'll have a better fourth quarter. Similarly, on the inflation front, I think the data points are better than actually the lower level of the RBI, comfort zone. So there could be scope for the RBI to actually, the monetary, to do a bit of heavy lifting as far as India's growth is concerned, and we might see some change in stance from a neutral to more accommodative, to more sort of liquidity support and rate cuts in the months ahead. So in the India macro piece, whether it's the growth, whether it's the on parameters like inflation, the deficits, both on the current account, I don't think we are going to be having any problems there, given the subdued outlook on crude prices. So therefore, the deficits of both the current account and on the fiscal front, we have seen anywhere the government is consolidating. When you add all this together, the macro picture for India looks fairly stable. And valuations, of course, for the large cap at least, are below their 5-year or below their 10-year average as well. So the starting point in that sense for an investor with a longer horizon, I think, is very constructive. But yes, can't deny that the There can be still a lot of volatility coming because of the global cues we are referring to. Yeah, I mean, uh, additionally, if you look at dive a bit deeper into the India story, it's not as if on, for instance, the consumption piece, we're getting incremental sort of sense that the rural part of consumption is looking better. We are waiting urban also to pick up, and we have seen that in recent times with the budget, the quality of the budget has been good for the last many years. It was more sort of focused towards boosting infrastructure, but this time around we've seen it more supportive towards consumption. And then again, in a year's time frame, a lot of government employees will get support from the pay commission. So maybe there is a pickup as well in the total consumption, both rural and urban, in the quarters ahead. But we have to wait and watch. So lots to look forward to. And lastly, while the government has been consolidating fiscally, but that magnitude of contraction they have been undertaking the prior 2 years, that will also start moderating. So I think, whichever way we look at it, the domestic economy should hold up well. Of course, it remains to be seen how we can successfully navigate some of these tariff and trade challenges, maybe through bilateral, individual, one-on-one deals with various countries, including the US, and that will be really, further supportive even to the export leg of the India story. So, on a top-down basis, at least the India part is fairly comfortable. And then, of course, as I was saying earlier, I think it's at this point more a bottom-up stock selection I would want to be, kind of following at this stage of where we are in the markets. Yeah, I mean, as far as the fund, positioning is concerned, um, at this stage, for instance, the fund has a ROE of over return on equity of at a fund level of over 20%, which is reasonably healthy. Just kind of is to support the point that we are in more quality part of the markets, and over the next 2 years, the earnings outlook is also in the mid double digits, in fact, slightly above that. And yeah, even for the large cap categories, I think, as I was saying, the valuations are below averages. And wait, wait. Um, oh yeah, thank you. You should have done that. So yeah, and for the large cap, as I was saying, the valuations are below average, and we'll see as the result season comes and concludes how much the earnings are holding up for this category as well. So all in all, I would say that one should have a positive outlook towards at least the large caps at this point of time, but with about a 2 year sort of horizon to tide over whatever volatility that the markets might throw.
Sure, Gaurav. So just continuing on what you sort of alluded and mentioned, we've seen that over the last maybe couple of years, mid and small cap had outperformed the large cap sort of funds by a very, very large margin. And that's why huge sort of flows actually went from a lot of retail investors in the mid and small cap funds. Basis all the sort of outlook that you've given on markets and the sort of volatility which could be expected over the next maybe few months or quarters, what gives you the comfort that large caps are sort of best placed to take advantage of the current market situation? And how should investors make their investments in large cap funds?
Well, I'll say that there's, of course, because there's comfort on valuations, there's comfort on at this point on growth. The composition of the large cap index currently gives that additional comfort that there's a large part from bigger banks, which by and large are trading at below their long period averages on valuations, and where we've been through the whole cleanup on the asset quality cycle. There was an engineered slowdown in their growth in the last few quarters, but I think that is also reversing. So there's a big cohort there which is getting that policy support as well. And then, of course, in the whole consumption part of the large cap, whether it is the staples to discretionary, we of course have to wait and watch. But there are signs, that consumption should hold up, is reviving in rural, could also revive in urban. So, there's a big parts there which are taken care of. And then, of course, uh, there are some other smaller parts like telecom or utilities, which have their own sort of low volatility characteristic, and where there's been a lot of reset in the prior year. So there's comfort on not just the growth, but also the improving profitability parameters of some of those smaller sectors. Even in the utilities, there'll be a fair amount of uh, expansion capacities which will come in the next few years, which will provide that growth, albeit at sort of modest return parameters. Uh, yeah, but having said that, while I'm sort of suggesting that investors should be building, or if they're underweight, basically in large cap, they should get to what is an optimal weight in their allocation in the scheme of things towards the large cap. But again, I'll also say that, for investors with a horizon of 3, 5 years, there'll be good, ideas and opportunities in the mid and small also, because there's a strong belief that, India is going to be reasonably good growth economy, and not just the large, but even sectors which are not adequately captured in large but are captured in mid and small, will also participate over medium long periods. It's just that maybe valuations there in some pockets had gotten a bit uncomfortable, etc. So there could be some time correction, but eventually that will be important. So I would not say that you just move lock, stock, and barrel towards one market cap cohort. One should be sort of optimally represented in his or her allocation across these cohorts. All of them are relevant, especially for a longer term investment horizon. While yes, in the short term, if these global cues get from bad to worse, there's a chance that we've already seen a lot of pain in some of the mid and small. That could continue, or maybe we are at the bottom. Difficult to take that call.
Sure. Thank Gaurav for sharing your perspective on the large cap fund and overall giving a perspective on markets. Partners and investors, we would be very happy to take all your questions in today's webinar. So please keep posting your questions. Gaurav, there are a lot of questions which have come from the audience. So maybe let me take few questions from the market participants. So what do you make of the reciprocal tariffs announced today? What is the implication for the Indian economy and the financial markets? And what do you think are the sectors which will be sort of more positively, or I would say maybe not negatively impacted by these news flows, and some of the sectors which could be negatively impacted by the sort of current announcements?
Right now we are at a stage where the markets have, had an initial knee-jerk reaction to these announcements. But as we know that these tariffs, there's one part which have been implemented under the emergency powers that the US president has, and that is, that up to the 10% level. But the rest, which have been announced on a country by country basis, and in India's case, I think it goes up to 26%. These, I think, will be open to negotiation in the days ahead. So it will not be correct to kind of take a very definitive call. For instance, at this stage, it looks like the pharma sector is immune to these, and that looks like one space where this problem should not be an overhang. The sector might have its own dynamics and own opportunities and challenges, but that's a separate thing. But just going by these tariff announcements, whereas on the other auto ancillaries, or maybe in some chemical companies might have to bear some brunt of these tariffs. But again, in the medium term, it's going to be a function of the cost advantage, the competitive advantage the Indian manufacturing entity has in that industry on a global basis. Because it's not as if India has had these tariffs imposed in a vacuum. There are a lot of other countries, as you might have seen, especially in Asia, that the manufacturing part of Asia, which was benefiting hugely from the China plus one, and a lot of Chinese sort of exports getting rerouted through them, they've had even higher tariffs, imposed on them. So in that sense, one can argue that India's competitive position might have even gotten better. So it's going to be very sort of nuanced. We'll get clarity in the days ahead because the tariffs themselves could get renegotiated. So just on the basis of today's announcements, I would not want to make some major kind of calls in that sense. As we know that this whole tariff thing has been on goods. Now services have been bereft, but there's a fear that there could be a slowdown in the Western world and especially the US. Now we don't know what magnitude that slowdown will be, whether it will be recessionary, etc. And then yes, sure. I mean, IT sector comes under that category where it has nothing to do with tariffs, but if their end customers were to face some immense pain, then the markets anyway have built that already in, I think, rightly or wrongly. But yeah, so that's a situation which is still evolving, because even the authorities there, whether it's the monetary or the fiscal in the US, will try to prevent, I would think, some major slowdown there or major recession there. So yeah, we have to see. So to your question on what sectors have should be immune. Of course, I mean, this is these two, three sectors are those which are in the line of fire, but otherwise all domestic facing um, parts of the economy within India. There's the banking, the whole BFSI, domestic consumption related discretionary staples, housing, all of that should hold up well, and especially as we're seeing monetary authorities become a bit more accommodative as our macros are holding up. So that part of the system, should do reasonably well in any case. It's more those sectors where there's an export linkage. Now, there's a part of it which is through the listed companies or listed industries, as we know, like we're referring to pharma, which should be immune, but auto anks, chemicals, which are on the side, which are hurt, in that sense at this point. But then there are others which are not even listed, the gems, jewelry, some of those kind of, any engineering, then there could be some listed companies or hit and others who will be hurt with that 26% at this point. So yes, there will be that. And lastly, it's also the sentiment part, right? There's that part of flows and, how that plays out into, risk assets, including emerging markets of which India is a part. So in that sense, yes, we have to bear this volatility, if it were to be a bit sort of deep or a bit more prolonged.
Thanks, Gaurav, for answering that question. Just let me go through some of the questions that are posted in the group. So there was one question that, Mirae said Focus Fund, which you also manage, has sort of completed 6 years or will complete 6 years of track record. It also had a terrific beginning. The first maybe 2.5, 3 years, it had a terrific track record. Couple of years also went through a challenging period like the large cap fund and has also bounced back strongly. So the partner, Mr. Mistry, wants to know what is the outlook for was the reason it got impacted in performance and what could be the outlook for the Focus Fund?
Okay, so hey, on the Focus Fund, this is of course the categories and 30 stock. It's a concentrated portfolio. So these are concentrated bottom-up stock selection, and once we get them, we would want the story to play out, and sometimes there can be quarters when a business, for various reasons, as we're seeing right now, there can be some businesses where the headwinds are very strong. They, if I recollect, in that phase, there was a time when the Ukraine crisis did disrupt short term the outlook for some businesses, and typically in markets, especially in some category in the mid and small, if there's an earnings impact which can affect fair value of businesses by at the most 5%, the volatility in the stock price is much more excessive than that, much more excessive of the magnitude of 25 to 30%. So especially when, we have a concentrated portfolio, there's more volatility on account of such individual positions. So that's the nature of this portfolio. But I think, as long as we're doing a good job of being uh, confident about the strength of the businesses and their ability to be creating value and their strength in that industry they are in, the value proposition they're offering to their customers, whatever business model they might have, whatever products or markets they might be catering to. We would want to, persist with them as long as, of course, we have, got them at good valuations and as long as prices are at valuations where there's a good enough gap with the fair value, we would persist. But that does mean that over periods of time you can have volatility in those positions, which impacts portfolio. So that's how I would say that this that category of the focused funds kind of is a bit different from other categories.
Sure. Thanks, Gaurav. There's a question from Mr. Chandan. He was saying that, there has always been this debate on growth versus sort of value, or quality versus sort of value. And this is sort of a debate which has always been there. And we saw maybe last year that value as a style did exceedingly well, and maybe growth as a style sort of did not do well that well. Do you see growth coming back to vogue in maybe over the next few years? And also a lot of good quality businesses, especially in the BFI segment, sort of lagged the other sectors. So what is your view on sort of growth versus value and quality filters over the next maybe 3-5 years?
To me, Vaibhav, I mean, growth is a subset of value. So even if we are buying a business which is demonstrating growth, which is better than the market averages, let's say, it's got a higher growth. But what is important is the price we pay for it. Obviously, the price we pay for it on an optical basis might look that is more expensive than say what the market multiple is. But if along with growth, the quality of the business is also good, the fair value of that business can be much higher than the price at which we have bought it in the portfolio. So while that business is a growth business, but to us it is it's got a price value gap, and therefore it is a subset of value. And conversely, with value as well, you can buy a business where surely there is a deep discount to what its fair value should be, and and then hope that at some point there's a trigger which kind of takes that gap between the current price and the fair value and kind of closes that, and you get a pop-up in that price value gap, and you can say that's a value business. Now, if that business was not really a growth business or it had a cyclical element to it, then those businesses have to be also exited, or the weights have to be lowered, because then beyond that value capture, what is there if there is no growth, or if it's cyclical and then there's going to be a cyclical downturn. So it's really very business bottom up specific, and depending on what price or what circumstance those businesses are available. And at any given point of time, I would think that the markets do throw up opportunities in that value bucket, and also, of course, in the structural growth parts of the economy. So I would say that our approach of being, which I mentioned at the start, of being 70-30, 70 in the long-term structural opportunities, and India has a lot of them. So the question of BFS. There's a lot of parts of the financial services where there's so much under penetration, still scope for good growth. Lots of parts in the consumption, from especially in the discretionary side, maybe some select categories in even in the staples side, where the scope for penetration-led growth, and as the demographics and the socio-economic profile changes, the scope for many years of better than average growth. So there's that structural part, and the market always throws up, these other opportunities in the value part as well. But to me, value is not just some numerical cheapness. It could be some cyclicals or some other businesses which is going through a very tough time, and there is uncertainty ahead. But yeah, there's a call that can be taken that okay, on a steady state by such and such time this can be unlocked, then we would be, we're okay to look at that also. So I think that's how this will still play out in the years ahead. There'll be opportunities in both buckets, really.
Sure.
Did I miss any?
No, no, I think you covered that, Gaurav. Uh, so, Gaurav, there's a question from Mr. Chandra that can you please let us know which sectors to look at in the current sort of market situation? Or maybe you can also add to it what is the sort of overweight calls you have in the fund?
Yeah. Okay. So as I was saying, I mean, we are a bit overweight on the banking financials, that part of the market, and also in some, across consumption categories. But it's also a bit of we have to watch for more signs of pickup. If you and then we would look to, kind of reinforce our positions. But yes, I mean, to the extent that there is volatility in the markets because of these global cues, uh, this one safe part to be is in the domestic related, sectors of the economy where there's no impact. On the other hand, while I would not want to, but if one has the time and the inclination to be studying some of these businesses and industries uh, which are impacted by the tariffs so far, there could be opportunities there as well, frankly, just given the fear which is there. So there could be opportunities in each of those, sectors with a slightly medium long-term view. Yeah, so I mean, the market will always throw up opportunities. It'll depend on how much time you want to spend, to try to pick on a bottom up. But on a safer side at this stage, I'd say that okay, the domestic facing part is kind of looking okay, and hopefully if the growth impetus is there pick up, it should be doing even better.
Sure. Uh, Gaurav, one more question from Mr. Paul is that in considering that we've seen a correction in the market, do you think this is a good time to make sort of lump sum investments in the large cap fund, or the investor can continue to make SIP investments in the fund?
Yeah, I would have been inclined to say a bit of a staggered approach should be appropriate. Uh, at this point of time, simply because the uncertainties which have come up overnight, so that expectation that the policy uncertainty get cleared, I don't think has happened because we'll still see reactions, counter reactions, and then there's just those variables of how those main actors in the countries, their central banks will behave. So that will continue to cause an overhang on the on market sentiments and short-term directions. So just by staggering it out, in case you have, see, if you are anyway kind of appropriately allocated, then you can continue with your SIP. But in case you're under allocated and you want to be looking to get to a more optimal weight, then you could stagger it over the period of a few months, so that you can maybe, if the markets were to be more volatile, you can just average that period out to get to a more optimal allocation. If you're already optimally allocated, then please continue with the SIPs.
Sure. So Gaurav will take maybe one more and maybe last question from the audience. This is a question from Tanya that we've seen that foreign investors had been net sellers in the market for the last many months now, and it's only recently that the FIs have become positive buyers in the market. And usually market participants will tell you that if the FIs start buying in the market, usually they will start buying the large cap stocks. So what is your sense on how the FIs will be playing the market for or investing in the market over the next maybe 6 months or so? And if the FIs turn from net sellers to buyers, do you think that the large cap segment will get a larger percentage of the flows compared to the mid and small cap?
Yeah, see, I mean, this is of course, technical question, and I mean, I would say that as investors, really, we shouldn't really try to be second guessing too much on these technical things of flows coming in, flows could be exiting. Yes, it's right that just for some days, uh, just for some days. A second, let me just get this there. Yeah. So it's conceivable that in the last few some days we have seen money coming back into emerging markets as as the dollar index has been weakening, and we've seen in fact some markets including China, Europe, etc., have been doing better, and the US has been correcting. But money which has been coming through the passive route into emerging markets, and then within which India also gets its due allocations, has been kind of, maybe what is underway. But yeah, I would not want to second guess of, whether how long this will continue, whether it'll strengthen, um, or whether, even long onlys will also kind of jump in at this point of time. But as I was saying earlier, that at least on valuations, there's comfort. On the domestic story, there is comfort. And, for investors, these are times to be, of course, definitely continuing their SIPs because you're getting to average. And if you're under allocated, to be kind of just staggering whatever bucket you want to, or the pool you want to be having, allocated towards equity. Yes, I mean, that question on whether large caps benefit when the flows come in and all that, there could be some, truth to to that. But then there can be also flows which are going into other cohorts. So yeah, I'll just leave it at that by saying that just keep a longer horizon, than the next 3, 6 months driven by flows. And at least we are very comfortable on the fundamental strength of the Indian, outlook and growth outlook, and for the economy, and even for the corporate sector. No doubt, some sectors are under fire right now because of tariff implications. But for reasons I've said, that we don't even know if how things will eventually settle, because it's not as if it's only Indian industry. Some of those Indian industries globally, also other countries are hurt actually more. So policymakers here also negotiating, and we could well find a better outcome than what is looking like today. So yeah, I would say that keep that slightly longer horizon, and that should hold up well for your portfolio outcomes.
Sure. So thanks, Gaurav, for answering all the questions from the audience and sharing your perspective on markets. Thank you everyone for sort of joining us today on this call. It's a very important period for us. Like I said, Mirae Asset Large Cap Fund completes 17 years of track record. One of the largest fund in this category, a terrific track record over 17 years of delivering more than about 4.5%-5% alpha during this period. Uh, During this period, we've had in the last couple of years challenges, but however, the investment team, fund management team led by Gaurav, managing this fund along with the entire research analyst, has remained the same, strengthened the overall research process, and that's where we've seen a rebound happening in the performance track record of the fund. And we remain very confident that this fund should be able to continue the terrific track record that it had created. Gaurav shared his perspective on the US market, the Indian market, the sectors to sort of look at, and how investors can sort of invest in a staggered manner with some amount of lump sum to take advantage of the sort of current volatility which is in market. Hope all the participants have got the replies for the questions they would have had on how they should look at and approach investing in the current market. Uh, Please continue to join us for webinars, and we hope to share very interesting thoughts and ideas through our various webinars. So thank you, everyone, and happy investing, and be disciplined when you invest. And maybe like Gaurav said, there is enough wealth to be created in the long term in India, and we need your support to sort of continue this momentum. And I would also like to thank all our partners for supporting the Mirae Asset Large Cap Fund over this 17-year period as well. So thank you. With this, we will conclude today's webinar.